trade combination. Pair trade, as I say, it is one of the best techniques of trading. And this beta decoupling pair trade techniques, Smart Finance innovated in the year of 2008. So till the 2008 to till date, it is a very good successful method. Those who are the high volume traders, those who wants to do a very big high volume trades in future, I'll suggest them to go for the beta decoupling. So first, a small intro about the beta decoupling. What is beta decoupling? So what is a beta of a stock? So here there are two parameters are very aggressively used in pair trade. One is a beta, another is a correlation. Correlation. So correlation says that if one stock move having a uptrend, if I am establishing the correlation between Nifty and Bank Nifty, BNF, so what is the chance? What is the probability that if Nifty goes up, Bank Nifty also will go up? So there is a 60%, 70%, 80%. What was the probability of move by the Bank Nifty if Nifty goes up? So if I say correlation is 60%, I can say that if Nifty goes up, there is a 60% chance that Bank Nifty also will go up. So that is correlation. So when we talk about beta, beta in numerical terms, it will be considered showing as 1.5, 2, 3, 4. So this beta says that suppose Nifty and Bank Nifty having a beta of 1.5. 1.5. That means if every 1% change in the Nifty will bring 1.5% change in the Bank Nifty. So if Nifty goes up by 1%, then Bank Nifty will go up by 1%, provided the correlation should maintain above 60%. Above 60%. The probability of up move should maintain above 60%, then only it will move up. So these two concepts we have clubbed in the year of 2008 or 9. So this fantastic method is got innovated. And here, as you see here, there are three stock symbol is there: ICICI, HDFC, Axis Bank. So here two buttons you are seeing in the top: positional and intraday. So when I say about positional, it's maximum holding period of minimum 3 days, maximum 10 days. When I say about intraday, so that is on the same day you should come out. So it will give you a perfect analysis as well as all its technicality. So beta decoupling, along with that alpha, Sharpe ratio, Jensen's ratio, Trenner ratio. So in your free time, you can just have a search on that and read what is alpha, what is Jensen's alpha, what is Trenner's ratio. So what is correlation? You are seeing here the correlation. ICICI and HDFC having a correlation of 0.24, very low correlation. Here 0.53. Here Axis and HDFC having 0.4. So the correlation is not matching this thing. So what? So when you go for this analysis, so these values you got computed. The right hand side, see here the ICICI and Axis pair. ICICI and Axis pair. So Jensen's alpha parameter says that Jensen's alpha, J alpha here. Jensen's alpha says that buy Axis Bank, sell ICICI, based on Jensen's alpha only. So here Sharpe ratio says that buy Axis, sell ICICI, buy Axis, sell ICICI. Beta decoupling also says that buy Axis, sell ICICI. Alpha also says that this is also buy Axis, sell ICICI. All parameters is telling this. But what correlation is saying, it is very important. Correlation says that trade recommended with option hedging, because correlation is very poor, 0.5 below, 0.6 below, 60% below. So it is telling that though all parameters are telling you to trade, but trade is recommended with the hedging. Spread analysis also we have added. Spread analysis, price spread analysis. What kind of price spread? The price ratio between their pricings. So based on that spread analysis also trade recommended. So out of all this 1, 2, 3, 4, 5, 6, 7 parameters, out of that important parameters we have taken 5. So here Buying is recommended ICICI Bank 0, selling 5, Axis 5, buying and selling 0. So here also you are getting what is their volatility, what is their uptrend breakout points, what is their downtrend breakout points. All these things you are getting on the positional level. So here what it is suggesting you, just have a look here. So entry process how should be? Buying Axis in the range of 743 to 748 and hedge it with a put option strike equal to or less than 729. Sell ICICI Bank in this range. Hedge it with a call option strike equal to this thing. So near to that. Exit if Axis fall below 733 or ICICI rise above 790. Here only you have to book loss. When it is given is an exit, so that means it is a loss booking point. If loss booking doesn't happen and if you stay in the profit, so neither of these prices will come. So it will go up and same time this also will be going up, or this is falling down. Same time this will also fall down. So if that kind of proportionate way it is maintained, then it will be a profitable trade. So record this trade and just have a look. If there is a chance you can enter the trade also. So there is not, if you are if you are a future trader and pair trading principle if you are following, so Axis is at, I'm going for equities here, you go for the so Axis and ICICI Bank we have seen here now. So here if you see, so here if you see ICICI has fallen more and Axis has fallen less today, and in fact this is our recommended price if it is maintaining. So here buying Axis 743 to 748, it is 739 now, we can buy it and hedge it with a 730 put option, and same way selling it 77 to 72 range, it is very much in the 74 range, so we can sell it here and hedge it with a 790 call option. So ICICI and Axis, you can very well enter the trade. So what is your trade? Axis you are buying, ICICI you are selling, ICICI you are selling. And if you are doing for intraday trade, suppose if you are going for the intraday trade, so this I am talking about future. If you are going for the intraday trade, same value you can enter. Means 100 shares there, 100 shares here. So 73. So here intraday analysis, if I am doing beta decoupling, trade not recommended. Correlation, trade recommended with hedging, and spread analysis, trade recommended. So here all these pairs you can say that trade not recommended, not recommended, not recommended. So these three pairs doesn't have an intraday opportunity. However, if you go for the positional opportunities still present here. So here whatever the what same process is still maintaining. So if you go for the ICICI and HDFC, beta decoupling set trade not recommended. Very low beta decoupling there, 0.6. So not recommended. So here it is a divided view. So 3 and 1, 4 and 1 study is neutral. Here too if you see 4 studies are for buying, 4 for selling. So Axis you can buy, HDFC you can sell. This you can do. So future only you have to trade, future only you have to trade, not in equity. So suppose if you are going for the future, so here I can just load the future. So future stock Axis is recommended to buy and ICICI is recommended to sell. So Axis, then I am going for ICICI Bank, and this is, and it will be recommended with the hedging. So with the hedging you have to enter. So perfect price, it is matching to our price and we can enter the trade. So we can enter the trade. So it gives you a complete picture. What you have to initiate if the trade goes against you, where you should exit. So all these things it is giving here. Suppose if I want to add one more counter, you can say, so you can say if I am just going to add State Bank of India instead of HDFC Bank, how it is going to behave. So if I just want to change here, HDFC, I am just taking it out. I am SBI, I am adding here. So load the data. So here, once you're loading the data, you will get all analysis done at a SBI and ICICI Bank. Beta decoupling is great, and here too also beta decoupling is great, as well as so what it is showing here with the SBI pair. So this ICICI Axis pair already we have seen. So ICICI and SBI. So ICICI and SBI is all places ICICI is being added. However, the correlation is low, trade not recommended. Correlation saying that 0.33 correlation, very feeble correlation, not recommended. So correlation must support you, then only all trades will be successful. To all your success lies here with the correlation. Irrespective of beta decoupling, the correlation is must for your trade. So correlation is recommending with hedging, it is okay. If correlation is telling that do not enter the trade, it is better to avoid. So here correlation trade not recommended. So all trades are favorable, however correlation is not recommended. So this particular tool, any stocks you can able to, any stock you can able to, you can do it from your side, Sanjay, if you want Ambuja Cement and Ultratech, any symbol you want, you can just do from your end. So here, what happens? That is one method. Second is we are using the volatility scanner. Here, what happens? What happens? Your all with respect to the Nifty, all stocks, all future stocks with respect to Nifty, all future stocks correlation and Z-score is being calculated. So Z-score is calculated. So here you can say all these stocks, whatever you are seeing here in this list, this list, all are being calculated with respect to Nifty. So here I am giving a broad definitions on these things, or a broad definitions on this particular pair trade. So here what I am saying here, if you are a you want to hedge it with multiple counters with respect to the Nifty, you can do so. Suppose you want to buy, say, sell the Nifty now. Nifty as at a higher level, you want to sell the Nifty. So which are the counters you can buy along with that? So you should have a good correlations or good you can say holding on your position. So here you can say if I am just going one by one counter. So here wherever I will find out 1.5. So 1.5 wherever I will be finding out. So 1.5. Here too also Bank Nifty also will appear. So here you can see Bank Nifty also somewhere you will appear in this particular list. So Bank Nifty yesterday you have seen that it was on the falling volatility trend. So falling volatility trend yesterday the Bank Nifty was maintained in the falling volatility trend. So today we'll see where the Bank Nifty is rising or falling or the no change. So here you can say yesterday it was in the falling volatility trend. So here you can, if anyone is running the software also can just inform me. So Bajaj Financial also, Bajaj Financial Service, most of these counters are in the rising trend. Today it is reported here. But here I am not seeing most of the counters are below except Mindtree, and we all are above. So here Bose also, this is also very illiquid counter, and SBI. So here these are very illiquid counters are present where I am seeing there is a 1.5 above. Pfizer, it's also again it is a very highly liquid counter present there. So here I can say Bank Nifty is having 1.58 now, 1.58 now. So this is so for that only. So here when Bank Nifty I am talking about, so Bank Nifty is having now correlation of 1.4867. Sorry, Z-score of 1.4867. Correlation 73% means That is, if the Nifty is rising, there is a 73% of chances Bank Nifty will rise. If Nifty is falling, there is a 73% of chances that Bank Nifty will fall. So these particular things you got. So now what you have to do here, 1.48 positive. Positive is for the buying. So here you can think of buying Bank Nifty, buy Bank Nifty, and you must hedge it. So Nifty and sell Nifty. Sell Nifty. So sell Nifty. If you go for the 1:1 lot, it is good. Contract wise also it is good. So if you go for the 1:1 lot, so here Bank Nifty is having 25 lot size and a 20 lot size. Here you have a lot size of 50. So 50 and 20. So see the whether it is equal value. How much value you are buying? If the same amount of value you are selling, if same amount of value you are selling. So you can say future index Bank Nifty is here. So you can Bank Nifty, if you are just enter this trade, this is a excellent trade. Today you can say it is Bank Nifty 39,114, 114.7, and Nifty is 17,951. So it is suggesting to buy Bank Nifty. So buy Bank Nifty and sell Nifty. Correlation is 70%. Still you hedge both the trades. Still you hedge both the trades. And here also one more thing we have given. So Bank Nifty, if you just double click on that particular symbol. So I just put my cursor here and double click there. So it is the current Z-Score. This Z-Score what you are seeing in this particular column, it is as per the yesterday's value, yesterday's closing. So closing value. So current Z-Score is 1.5364. So it is an excellent level. So what you have to 1.53. Also correlation is above 70%. Excellent level here. So only thing is that we have a fear of consolidations because of this fall in volatility. So you can think of buying Bank Nifty now and selling the Nifty. So selling the Nifty and buying the Bank Nifty, lot you can adjust, and selling of Nifty should be protected with one call option. Buying of Bank Nifty should be protected with one put option buy. So selling of Nifty must be protected with one call option purchase, maybe nearest call option 17,950 or 18,000, and same process the buying of Bank Nifty must be protected with one put option, preferably 39,100 or 39,000. Monthly option you can go for. So these pair trades are highly successful in the monthly options and positional trades. It may not be that much successful in intraday. So here, if you record the trade, we are going to buy Bank Nifty at 39,111. If you record the trade, we are going to sell Nifty at 17,951. So this is the recorded trade, and this method doesn't follow any stop loss. Why you compare everything? Trading in pair trade option strategy, there you don't require the stop loss. Where you should enter, what should be your exit point. So if you ask me where I should exit this point, so here what happens whenever we are doing the analysis and this trade, suppose we have just initiated, Bank Nifty we bought, Nifty we sold. So here, based on the lot size, you may go with 1 lot, or you can go with 2:3, 3:5, anything. So 2:3, 3:5, because here lot size is 25 and their lot size is 50. So you adjust the values. So here, if you are 2 lots selling, you must buy 3 lot. So contract values you must keep it almost same. So near strikes of that you will be hedging. So here, if you are hedging, will have double benefit. One, it will reduce margin. Second, it will have a protections of your trade. So pair trade is not, even though if it doesn't go in favor of you, so you can roll it over. Suppose if you initiated this trade, so after day end, because here I told you just double click, you will find out what is the exact. So here you have just few minutes before you have seen that 1.54, now it is 1.57. Suppose now it is increasing. This Z score is going on increasing. So Z score is going on increasing. So what you have to do here, say you have entered at 1.5 Z score, 1.5 Z score. So it has gone to, say, after 2 days, this 1.5 Z score has gone to 3.5. So what happens? Trade is going against you. Once the Z score is going on increasing, trade is against you. But you have a protection of the put options. So once this Z score is doubling up, you have entered at 1.5, it has doubled to 2 times it has become. 2 times it has become. So what you have to do, book the profit in options. In that time, what is happening? The options, the proportionate way or bank nifty is falling more, nifty is falling less as compared. So Z score is going up. So book profit in the options, option component, and rehedge it. Rehedge it with the other different strike options. Keep it, keep this trade alive. Don't kill that trade. So what you have to do, just keep that trade alive, keep booking profit in the options. So once that Z score as per the Nifty and Bank Nifty, it can go to a level of 4 to 4.5. This is the normal it maintains in our Indian market. 4 to 4.5 it will expand. After 4 to 4.5 of expansion, it will start contracting. Z score will start contracting. So say for a journey till 4 to 4.5, it has started with 1.5, it has gone to 4.5. So 2 times you have booked the profit in the options and you rehedged it. And Z score now started recovering. So what will happen? This positive Z score will go to 0 and negative. You will get maximum profit when this Z score become minus 1.5. So once it becomes minus 1.5, what you have to do? Reverse your trade. So you have to sell the bank nifty, buy the nifty, and again rehedge it. So it is a continuation of the trades will be there, and it is a highly rewarding trade. So Z score, and then you, based on your own capacity and intelligence, you can start hedging it the process you want. The process you want, you can start hedging it. So normally what I have experienced, any pair trade carried for 3 months, 3 months period, one pair of Nifty and Bank Nifty pair trade, if it is non-successful and carried for a month-on-month basis for 3 months, because this month it has not given, so you have rollover to the next month it has not given, again you roll over to the next month. If any pair trade gives carried over for 2 to 3 months, based on the margin employed in that capital, it gives an average return of 15 to 20%. 15 to 20%, 15 to 20% average return of 15 to 20% per quarter every 3 months. So it means it is a highly rewarding trade, and it is highly rewarding trade. And in case of a deep corrections and deep corrections, in case of the deep correction, suppose you initiated a pair trade and there is a huge correction happened, or huge rally happened, huge rally or huge correction happened, your return goes to per quarter 20 to minimum 20 to 60% per quarter. So 60% per quarter. You have seen that in my earlier videos in my YouTube channel. In the March 2020, April 2020, May 2020 till June 2020. That time we have conducted a program, specific exclusive program on the exclusive program in the pair trade. We have conducted one excellent program purely on the pair trade. That is also along with this software. You can also find out those videos in our website. So I have explained the theoretical concept behind that and other things. That time we have clocked per month wise some 30%, 33%. If you can see here, you can see that our pair trade courses, if you just see 2020, we have conducted this. So you can say Master 4 pair trade courses. So this particular course, when it has 4 modules I have taken, and with live market practice. So this has happened in the year 2020. So this year we have not conducted any pair trade program. So I have explained one method, 4 methods of pair trade, how to initiate along with this thing. So this software also is being, that time also we have given to the users for 1 month period. So we have experienced that it has gone to monthly wise some 30%, 35% it has gone for. And it is very safe trade. That is the biggest advantage of this trade is you can initiate this trade and peacefully you can take rest in your home. Peacefully you can go for your work. You need not have to watch the market 24 hours. Or you need not have to be nervous that yes, SGX has fallen by 200 points. What is going to happen to my positions? So all those worries or ambiguities will not happen to you. So question comes here, why this Z-score and beta decoupling works? So why this Z-score and beta decoupling works here? What makes this method to work? Any idea? So here you can see market always works on one principle. It is market doesn't work on your technical principles. Market doesn't work on any of your technical indicators and all these things, oscillators and all. Only one principle in the market, that is demand and supply. Demand and supply. So suppose one FI, or just imagine one small example, some foreign institutional investor, he came to India for 100 crore. So they bought some shares of worth of 100 crores. Do you think that once, so they will buy this 100 crores and just wait when that 100 will go to 200, then 200 will go to 300, they will make money, or some shufflings they will be doing. So always that shufflings happens. The large institutionals, specifically the mutual fund managers, specifically for the FIs, there is a constant churning on the portfolio. Constant churning. So you can say that, so you are seeing any mutual funds analysis, they are saying that there is a constant churning. The churning or rotations happen. Some counters they come out, they can accumulate something. Somewhere they are reducing their holding, they are adding, increasing the holding in some other counter. So that normally happens based on the sectors. Suppose banking sector, they found out that okay, this one counter of banking has gone for a good rally. So they will reduce their holding on that and they will enter to some value companies in the same banking sector. So this particular demand and supply movement happens in the market always by the large institutional investors. So as a small investor, as a retail investor, how I will know that what they are going to do on particular stock specific basis? On stock specific basis, as a retail investor or a trader, how I can know that? So here, as a retail investor, whenever I say that this is the beta is negative or beta is positive, beta decoupling is positive. So when beta decoupling is positive, that time what happens? If you can see here, ICICI and SBI pair, what it is telling? ICICI by 5. So beta decoupling, it is saying that the supplies have enough happened in that ICICI bank and many sellings has happened and same proportionate selling did not happen in the SBI. So when you go to the Axis and ICICI, if you compare between these things, so here supplies have happened in the Axis, many sellings has happened in the Axis, but equivalent sellings has not happened in the ICICI. So when this beta decoupling, always I used to say, when here you are seeing the big fixtures, point -3, 19, 13. So when this beta decoupling goes -2 or +2 above, because of a huge rally, we are seeing these big numbers now. And this is the result season also. So here, otherwise, whenever there is a beta decoupling, -2 and +2 level happen. +2 means the counter, which is the first counter. So the first counter here. So first counter is, or you can say it is independent, it is dependent. First counter is independent, second is dependent. They are also chosen based on their volatility. Any counter having higher volatility should be independent. So here what happens, whenever there is a +2 or -2 beta decoupling happens, that is a demand saturation or the supply saturation. So no more supply will come in there, no more demand will come in there. So that is what it says. And here to Z-score also gives the same sense. 1.5 means that supply has enough, means Bank Nifty has sold aggressively as compared to the Nifty. So now what is going to happen? Whether that sale is going to continue or the supply is further going to continue and demand is going to build up in the Nifty or it will recover. So these particular three parameter, beta decoupling, correlations and Z-score are giving you a information's current stage, but where your demand is standing and where your supply is standing. So no, it is not with respect to the main revision. So here, this gives you a complete sense that whether the demand is saturated or the supply is saturated. So based on this only you are entering the trade. So you are in the side of the large institutional investors. With your small capital, you're still in the side of the large institutional investors. What they're thinking currently, you are going to implement slightly before that. So that demand and supply situations mathematically you are studying through by the help of Z-score, by the help of beta decoupling, by the help of other parameters. Though I am just naming these two, but all these things, Sharpe ratio, Jensen's ratio, Trainer ratio, your here the Anil Joshi, what he has told about the mean revision. Mean revision is nothing but your spread analysis. The spread analysis what we have mentioned here, this is based on your mean revision. So all these methods are giving you which counter is now at a level of supply saturation, which counter is now at a level of demand saturation. So whichever is having a supply saturation, you are buying it. Whichever is having a demand saturation, you are selling it. So whichever is cheaper, you are buying. Whichever is costlier, you are selling. So that is what only you are doing. So once you are doing that within 4 to 5 days, 3 to 5 days period, that so they participate. So based on this analysis, they also institutional also participate. So can anyone will tell me, any of your institutional investors, they are following your candlestick and other things, but we are more passionate about mutual funds, institutionals. Anybody is using this concept of our candlesticks, 5 candles or jumping like a floating fish, anyone is jumping in the market. Model of our technical analysis, all 1970 model of our technical analysis, your RSI, MACD, all those things, whatever is there, they never follow any of these things. So what is being followed there? So there, earlier days it was completely followed with your specific mathematical ratios like Jensen's alpha, Trainer ratio, beta, alpha and all. But currently sentiment indicators, currently not those forward earning and other things, sentiment indicators, neural network theory, which we are using in our real-time volatility calculators. So our real-time volatility calculator based on the neural network theory. Neural network theory, Brownian's movements, all those advanced concepts, behavioral indicator, have a source on that. Behavioral indicator. Behavioral indicator is called as a crowd pulling. For crowd pulling means what people talk. Majority of the ICICI Bank traders, how they are talking in different social forums, like on Twitters, like on Facebook, like on all these things. So how you can, so those sentimental indicators also can be pulled with the big data minings. With the data mining, you can do it. Or you can do with your Monte Carlo simulations methods, you can do it with your Brownian movement method. So all those advanced methods are being utilized there to know the supply and the demand situations. And whatever Anil Joshi ji also told that mean revision method, that is also a very advanced method, and it is that method is much above the simple moving average. Here mean revision method we have used as a spread analysis. So we named as a spread analysis. This is the mean revision method. So all these methods are currently used. So only the retail traders are using all those 1970 model. Many of you do not own a car for more than 5 years. 5 years. None of the mechanical instrument of 1970s are nowadays used in any of your factories. So factories running on 1970 model of machineries are no more available here. So here we are obsoleting many mathematical studies and bringing many new things for our course curriculum also. So the course curriculum of engineering in 1970s and course curriculum of 2020 to 2021 are entirely different. There is a sea change in that curriculum, but only one study is utilized till date in 1970 studies, if I am not wrong. Capital markets, moving average, indicators, oscillators, blue and red blinking lines, all these things are currently utilized. Yes, we are so passionate about that. That is got marketed well to us. So here, for that reason only, I used to say, use the Fibonacci, nothing wrong in that. Use the GAN, nothing wrong in that. Just add some new concept to it. What we have attempted here in Smart Finance, all our same natural constant, volatility, Fibonacci, all these things, what we are adding here, we are adding volatility into it. And this volatility is being calculated real-time basis. Means whatever the volatility at the 10:20, now the same volatility won't be there at 12 o'clock. So this volatility also is being computed through neural network process. So here, this is the price action happened from 9:15 to 10:19. So we just create a map, the similar price actions. We are just mathematically generating different price points using the neural network based on its past action. So from there, we are thinking that whichever the price actions are having a probability of acceptance more, we are pulling those data and using the GARCH method, GARCH method, to compute the real-time volatility. And that volatility, using that volatility, we are estimating the price range. This is the price range. And those price range we are using with the Fibonacci ratios to compute the levels. That is same Fibonacci ratio we have not changed. So the old Fibonacci ratio remains same, but the price range has changed. It is being estimated from the volatility. Same process we are propagating through this your pair trade method. So here I have just given you two pair trade estimations here. If you are not entering the trade, also keep following that trade. I have estimated and told you Bank Nifty you can buy and Nifty you can sell with the hedging. So this is the first pair trade, and same time see here 1.57 you have seen, now it is 1.51. So keep watching these levels. Once you initiate this and open the software, and day end once you watch also, it is okay. So once it goes to zero, Z-score goes to zero or negative, you are at a profit. You will get a maximum profit when it goes to 1.57 minus 1.50. You have entered at plus 1.50. You are at a maximum profit at that point. So each expansion 1.5 you entered, it goes to 1.3. You have to just book in the profit in the options, keep the future trades alive. And second trade I have just told you. So yes, you have to do it with the Bank Nifty and the Nifty. So Bank Nifty and Nifty futures this month contract. So if you are going with the ICICI and the Axis, so here ICICI need to be sold, Axis need to be bought as per the beta decoupling concept. So here, as per the beta decoupling concept, so here you should exit, and both should be hedged. Both should be hedged here. Both should be hedged. And if Axis falling to 730 or ICICI goes to 790, you have to exit the trade, or else keep checking for your beta decoupling. So Axis and ICICI we have a beta decoupling of negative 3.4. So once this beta decoupling comes to 0 or positive 3.4, we'll have a maximum profit. Positive 3.4 or 0. 0 onwards, we'll make profit once it is coming to 2 minus 2. It comes to minus 1, profit will be there. We don't quit the trade. So once it goes to 0 or plus 1.3 or 1.2, that time you should book a bigger profit. So book a bigger profit, that time the same opportunity, if it exists, you can just sweep your trade or sweep your trade. Axis you can sell, ICICI you can buy, or you can hunt for other opportunity. And this is a highly rewarding trade. He has asked, Sanjit Thomas ji has asked, whether the the stocks should be from same sector. It is a must. You should not have a pair with Reliance and SBI. You should not form a pair with the Reliance and SBI. You can form all cement stocks, banking stocks, IT stocks. If I am going for Infosys and TCS, so this will be same sector. TCS and Nifty should be with the Nifty stocks. It will have a better result. So TCS, and I can go for the Tech Mahindra. So these three are the large IT companies. I can just load this data, and once you load the data, the system takes care of entire thing. It analyze everything. It just give you the final outcome. So just couple of seconds, you are just giving it. This Tech Mahindra and TCS negative. Here too also Tech Mahindra Nifty negative. TCS Infosys positive. So TCS Infosys, if we can go for here TCS Infi. So here TCS views are divided. So here correlation is favorable, but spread also favorable. So but here all beta decoupling and other things, 4 studies. So here 3 studies in favor of buying Infosys and 2 studies for the TCS to buy. So you can views are slightly divided. But if you want, you can initiate, but this kind of positions won't give you that much success because views are divided. Though other parameters, if it is a 5.5, so see for the best pair, which can give you 5.5. So here Tech Mahindra and Infosys having a great combination here, trade recommended, and that correlation is great. Recommended without option hedging, correlation is also great. Here without option hedging, currently you need not have to hedge. You can wait for some time and hedge afterwards. This is a good pair. Also you can initiate. So buying Infosys, selling Tech Mahindra. This is also a great thing. It has there. Good pair, excellent pair. It is there. So Tech Mahindra TCS, Tech Mahindra sell, TCS buy. These two also correlation trade not recommended because it is very feeble correlation. So here trade not recommended. So spread analysis, win revision analysis is telling that trade is recommended. So here all these things you can follow. So here any stock you are taking, there should be, if they are from same sector, it will be highly useful. Stocks are having very less accuracy, less than 50% accuracy on the. So why that methods are not successful? There are different reasons. So here when that moving average or indicators are being moving average and indicators are being innovated, those times floor trading was there. People used to go to the exchange floor, shout and do that. So flow of information was slow. Price was not a tick by tick graph information that time. So price was a day end graphing was there. So it was a slow movement of data was there. So that time it was what kind of data we used to tell whenever you look, many of you are studying that technical indicators. If you see, they are telling this data is a discrete data using the discrete DIS, discrete. If you are a student of statistics, you will be knowing that. So they are all indicator. Those who have innovated this indicator, Bollinger or anyone, they have said that stock market, this price data what we have taken, it is a discrete data. But currently what we are using, current data is a discrete random data. this currently the data is discrete random data, means this discrete data means it has a very slow flow and a low flow, but it is currently what is that discrete and random data. Every second, every pip the data is flowing. So once the discrete random data has happened, those indicators, no one has taken the pain to recover or the revise those methods from discrete data to how to implement Bollinger Band in the discrete random data. So previously Bollinger used random data, RD. So now it is discrete data. So now it is a discrete random data. So this no one has taken it forward. So for that reason only those indicators are slow. Bollinger, they are telling if you have a standard deviation of +2 or -2. So this is what mid band and upper band and the lower band you are using standard deviation of +2 or -2. But what is the standard deviation? It is again derived from the volatility. So all stocks are not having +2 or -2 standard deviation. Why that man has told +2 or -2? The reason is when that has been innovated that method, data was slow and none of the stocks was giving a standard deviation beyond +1, +2 to -2. So what about the preceding years, preceding 30, 40 years, they have not given a standard deviation beyond +2 or -2. But currently what happened? Currently this is a discrete random data. Our standard deviation is going to +10 and -10 also. And in fact, you will surprise when the March fall, 2020 fall has happened, the standard deviation of the crude oil and other things has gone to negative price, means it is gone to infinity. So which was not predictable that time, because now it is a discrete random data. So data itself is wrong. Now data itself is changed. So once the data is changed, how you can utilize that things? So that is the problem. Not you here, data itself, you cannot trust that it is now, yes, 1.8 it has created, but sometimes it can go 3, 4, 5, many counters you can see that here. So now this you can say little stable market, so you are not getting that kind of values. But when there is a wild market, you can find out many places this Z-score can go to 3, 4, 5 also. 3, 4, 5 also it has gone. So many places it has gone during the March fall and other things we have experienced. It has gone to even Z-score has gone to +10 and -10 also. So in that case, you don't leave the positions unprotected. Suppose 1.5 you entered Bank Nifty and it is going to 3 or 4. What do you have to do? Just come out from that position options and re-hedge it. That's all.